everyone. A very good evening. You're watching The Money Show on ET. Now, this is your one-stop shop for any questions and queries that you have on your personal finances. I'm Mubina Kapasi, and here's what we have lined up today on this half-an-hour edition of The Money Show. First up, it's the 23rd of June, and it means there's just 1 week left for the last leg of your tax-saving investments. Yes, usually tax-saving investments are done before the 31st March of every year, but thanks to COVID-19, FM Nirmala Sitharaman granted an extension to assessees to make tax-saving payments by the 30th of June. So we are going to be talking about some really last-minute tax planning investments that you can make and how you can really cut down on that tax bill. Later on the show, we'll also be talking about of course, about mid and small cap funds and some interesting trivia with respect to travel. Today, countries want you to book your holiday now and, of course, enjoy it later. So, what are the offers on the table, and does it make sense to really book it now and grab a good bargain offer? We'll be talking about all of that today on The Money Show. But first up now, let me introduce Mayur Shah of EY India, today's expert and veteran in the world of direct tax matters. Mr. Shah, really appreciate you joining us today on ET Now. And yes, it's now literally the last 7 days for tax planning. There's not going to be any more extension for tax saving investments in FY20. However, Mr. Shah, it's important to understand that we are in the midst of the COVID-19 pandemic, right? So it's obviously going to be difficult to simply just walk over to the nearest bank branch and, make a PPF investment or any other, investment that could be eligible, to be claimed as a deduction under Chapter 6A or any other tax deduction. So for those very last minute tax saving tips, Mr. Shah, what would you recommend?
Sure. So, currently what we can really look for is, making payments for LIC, making online payment for PPF and etc., where, the maximum benefit which you can be availed is 1,50,000. Or, we can make donations which are to the charitable institution, PM care funds, etc., where, you could get deductions. If you make all these payments by 38th of June, you will be entitled to, make a claim against your income which is being earned during financial year 1920, even though payment has been made after the financial year which has ended on 31st March 20.
Okay, all right. Now, Mr. Shah, what's available today for tax-saving investments? Recently the government slashed the interest rates on PPF. When it comes to ELSS, markets are so volatile. So how would you recommend, assessees essentially manage their investments amidst all of this volatility that we are seeing?
So if I look at it from an investment standpoint, I think ELSS, given the market conditions, and uncertainty about which industry is likely to grow given the kind of new normal which will come up, I would feel more safe if we invest in debt funds such as PF, PPF, etc., where there is certainty of income and principal being there. And hence, I would normally prefer the investment to be made in a safe securities.
Okay, Mr. Shah, I also do want to talk to you about, the new income tax forms that have been released. We're asked the question that, is every deduction, firstly, for example, interest on home loan, the amount that you pay in April to June, can that as well be claimed, because now that the extension has been granted, right, for tax saving investments till the 30th of June. So would interest on home loan as well be available as a tax deduction in FY20? And also, I'm just going to club this question as well, the new income tax forms, if you could just talk to us about the provision in the form to ensure that, any investments you make between April to June as well are included.
Yeah, so you have brought up a very brilliant question in terms of what happens to the loan payments which are being made in financial year 2021. So this deduction for principal amount, repayment of principal amount can be claimed as a deduction under Chapter 6A under Section 80C. And if the payment is made even from April to June, that should be eligible for deductions under 80C. And therefore, such repayment of loan can also be claimed as a deduction while calculating taxable income.
All right. What about the new forms that have been released? Mr. Shah, if you've gone through them, what exactly is standing out? How are they different from last year's forms? Because I know, the filing date is now all the way the 30th of November, but still, the forms have slowly started being notified. And if you have all the data, there's really no reason why you need to push your return filing till the 30th of November. So yeah, what are your observations on, something interesting in terms of additional disclosures that has come by in this assessment year's income tax return?
Sure. In terms of change from last year, and as you rightly brought up that, because we are able to claim deductions for payments made from April to June, and if you want to make a separate claim for that, then disclosure needs to be made in the return of income in terms of what all payments which has been made from April to June, which you want to claim as a deductions against the income from for the financial year 1920. So that is one item which has been added. Another, which is most interesting item which has been added, is that, if anybody has deposited an aggregate amount of 1 CR in one or more current account all put together, then that has to be reported separately over there. The another thing is that, if anybody has spent more than 1 lakh rupees for electricity consumption, then that also needs to be added and disclosed in this. And if anybody has spent more than 2 lakh rupees for foreign travel, that is also required to be disclosed herein. So the change is more about, in terms of what we have spent, how we have spent, and where that has to be disclosed. This is in order to verify if any expenditure are incurred and do you have sufficient source of income to incur such expenditure or not. And in order to verify that, that has been added over here. So apart from that, there is not major change from the last year which was there. And that is what has been added in the new forms.
Okay, all right. So very interesting. Certain additions are there in the new forms. That's the AY 2020-2021. Basically, what you will have to file before the 30th of November. Well, that's not the only form that has undergone a change. Mr. Shah, allow me to squeeze in one more question on Form 26AS. Almost like a tax passbook of sorts, if you could call it that. It's literally going to show you A to Z of everything with respect to taxation, how much you have paid, how much TDS has been deducted. So essay tax, advance tax, and I think now, Mr. Shah, from what I understand, even certain incomes will be included.
Sorry, I'm sorry, but I could not hear your question.
It was about the Form 26AS. What are the new inclusions and exclusions in this Form 26AS?
Yeah, so 26AS is not a return form. It is just a confirmation of the amount of taxes which has been paid on your behalf, the income on which TDS has been done. So now Form 26AS will contain all information which from whichever sources they have received. And, that is reflected on Form 26AS. And somewhere, inquiry may come if we are unable to, justify that this information is right or wrong. And this may add to the complexity in terms of when return is to be scrutinized. many a times they will cross verify with what we have submitted in the return of income and what is reflecting on form 26AS. And if that has not been met with, then there will be an audit which will be conducted, or we call it as a scrutiny, which will be conducted by the tax officer on the return, and all explanation will be demanded by that. Earlier, this used to be collected through AIR information. Those information never used to reflect on Form 26AS, and now it will reflect, all that information will reflect on Form 26AS. And onus will be on the taxpayer to see that those informations are correct or wrong, and appropriately intimate tax office that this information seems to be wrong, if it is wrong.
All right. By the way, apart from this, there's also the cost inflation index, which has been notified for FY21, and this has come in at 301. Just another question, Mr. Shah, on this cost inflation index. Why is this one essentially important, and what ramifications could it have for those assessees who have capital gains, that could be coming up in this financial year?
Sure. And this inflation index is being utilized or used for the purpose of calculating long-term capital gains. So if any immovable property which is being sold during the current tax year and it has been bought a couple of years back, then the cost needs to be enhanced through inflation, applying inflation index. Let me give you an example that if a property which was bought in 2000 where the inflation index was say 100 and today it is 300, and the cost for purchasing that property or that item is say 10 lakhs, now it will be considered as cost will be considered as 30 lakhs because it has gone up 300 times. So cost of inflation index gets enhanced because of this, and therefore inflation index number is very, very important in terms of calculating appropriate capital gain and to pay appropriate taxes thereon.
All right. Okay. Yes, the cost inflation index is indeed very important, especially for those people who are selling an immovable property. For this year, it has come in at 301. So if you are selling a property today, rather between April and March, this cost inflation index is important for you to calculate your capital gains or loss as well, could be that too. Okay, let's take on board some questions and queries. We've received quite a few of them, so let's try and squeeze in as many as we can. First up, we have Praveen Kumar, who writes into us saying, I'm a merchant navy officer and trader. Sometimes I achieve NRI status and sometimes residential status. How and which form to file returns, and how will my income be taxed in each condition, such as if I achieve NRI status and if I don't achieve the NRI status? Interesting question. And after the entire budget 2020, I remember there was a whole confusion as well among those individuals who are seafarers, Navy officers included. Mr. Shah, how would you guide Mr. Praveen Kumar?
Sure. So, first we'll see that for financial year 1920, when a person is a non-resident or not ordinarily resident, then he is required to report income which is earned or received in India, or income which is being accrued or arising in India. So let us take an example that if he is rendering services in say non-Indian territorial water, that need not be included as Indian income, and on that taxes are not required to be paid unless it is received in India. And when a person is a resident of India, in that case, he is ordinarily resident. In that situation, he is required to offer all income, entire global income will be subject matter of taxation in India, and accordingly, taxes needs to be paid. When a person is a non-resident or not ordinary resident, he has to file ITR 2 or 3 as the case may be, depending upon stream of income and the total income which is required to be offered to tax. Whereas a person is resident and ordinarily resident, depending upon the level of income, ITR 1 or ITR 4 needs to be filed. So this is how a matter needs to be dealt with. The other interesting question which you had raised, that given the current or new provision which has been introduced, which is in case where a person is a Indian citizen, how they would be taxed. So in the current budget, and now it has been enacted in the law, when a person is an Indian citizen and if he is not liable to tax in any other country by the reason of domicile or residency in that other country, in that situation the person will be regarded as a resident of India. However, there are several situations under which he will be regarded as not ordinarily resident. And if he is regarded as a not ordinarily resident, in that situation he will be liable to tax in India only in respect of Indian sourced income or income which is received in India, like a non-resident. But if he qualifies to be resident and ordinarily resident, then he will be subject to tax on global income. So to this extent, if he is an Indian citizen, then there could be some challenge in this respect.
Okay, yeah, that's quite a comprehensive, review of basically what exactly the implications are for an individual who is a seafarer whose residential status as well alters depending on what his projects or what his assignments are like. Okay, let's move on and take on board another query. It's a tax related query. This one, of course, is coming in from this one's coming in from Nayan Gandhi. He asks, can long-term capital gains be adjusted against long-term capital losses in mutual funds and in equities? Well, yes, Mr. Shah, now that LTCG on equities as well is taxable, his question is, can that be used as a set-off against LTCG, which probably will be on an asset other than mutual fund and equities, hence this question arises. So Mr. Shah, what's your view, what's your understanding?
Yeah, so long-term capital gain can be adjusted against long-term capital loss in mutual funds as well as equity funds. However, one has to be very careful in terms of analyzing what constitutes long-term capital gain and what constitutes short-term capital gain. Equity-oriented mutual fund or equity shares, if it is being held for more than 12 months, in that situation it is being considered as a long-term. If it is an unlisted equity shares, in that situation such shares should have been held for more than 24 months to be qualified as a long-term capital gain or a loss. Similarly, if it is a debt mutual fund, then one needs to ensure that it is being held for more than 36 months to be categorized as a long-term capital gain or a loss. So one just need to be very careful what will be categorized as long-term, but long-term capital loss can be adjusted arising on account of investment in equity mutual fund or equity shares or debt mutual fund can be set off against other long-term capital gains.
All right. Okay. So that's a very interesting insight essentially given by Mr. Mayur Shah. But on that note, we're not going to be able to take any more questions and queries. So thanks so much, Mr. Shah, as well for joining us, telling us all about and sharing all those last minute tax saving tips. Folks, this is literally very last minute. And yes, but thanks to, digitization, you can simply make your tax saving investments by the click of a button. All right. Well, that's of course our discussion on taxation. Last 1 week left for tax saving investment.